Let me set the scene. This was a real deal, a real borrower. Property located in a suburb of Salt Lake City, Utah. And on paper, everything looked right. Purchase price, $285,000. Rehab budget, $65,000. After repair value, $430,000. Clean exit, list it, sell it, move on. Classic fix and flip, right? He needed a 6-month bridge loan. He shopped around, which is smart. You should shop around. And he got 2 offers. Lender A, 8%. Us, High West Lending, 11%. Now I want you to think like a business person for a second. On a $285,000 loan over 6 months, that's a 3-point difference, and it works out to roughly $4,500 in interest savings. That's real money. I'm not going to pretend it isn't. So he went with Lender A at 8%. Makes sense on paper, the math checks out, except math only tells you what something costs. It doesn't tell you whether it closes. Here's the thing nobody puts on a term sheet. Rate is one variable. It's the one that's easiest to compare, so it's the one that gets all the attention. But there are other variables, and they matter a lot more when a deal goes sideways. How fast does this lender actually close? Not what they say, what's the actual average? Do they fund in-house, or are they brokering your loan to someone else, someone who doesn't even know your name? Do they require an appraisal? Do they require experience, tax returns, credit report? Do they have one decision maker, or does your file sit in a loan committee? What happens if the title company has a delay? Does your lender problem solve, or do they go quiet? These questions are invisible on a term sheet. You have to ask them to your lender directly. And most borrowers don't because they're focused on the number, the interest rate, the cost. I've been doing this for almost 20 years. We've funded more than $550 million in loans, and I can tell you the deals that blow up don't blow up because of interest rate. They blow up because of execution. Rate is visible. Execution risk is invisible until it's too late. So what actually happened to this guy in Salt Lake City? Let me walk you through the timeline, week by week, because this is where it gets real. Week 1, loan submitted. Lender A starts underwriting. Lender A is our 8% lender. They ask for documents, tax returns, bank statements, credit. Borrower sends everything same day. So far, fine. Week 2, still underwriting. Some back and forth. A few more document requests. No big red flags yet, but the clock is ticking. The buyer has a closing deadline. Week 3, appraisal gets ordered, except it doesn't come back. It's in process. And anyone who's been in this business knows once you're waiting on an appraisal with no timeline, you're waiting. Week 4, the seller starts asking questions. When are we closing? The borrower calls lender A, gets reassurance. We're on track, just waiting on the appraisal. Here's where it falls apart. Lender A said they needed another appraisal. Problem with the first one. They need an extension, another week. The borrower asks for an extension. The seller says no. Week 5, the seller walks. The contract is terminated. The earnest money deposit, $5,000, it's forfeited. And the property, the seller took a backup offer, a cash offer. The total damage? Between the forfeited earnest money and the deal he missed while stuck in processing with the 8% lender, we're talking $40,000, all to get a lower interest rate. Now let me show you the actual math. How did I get to that? Scenario A, you go with the 8% lender. They don't close. You lose your earnest money. You miss the deal. You spend 4 weeks in limbo. You save $4,200 in rate. Scenario B, you go with the 11% lender, us. We close in 7 days, deal funded, rehab starts, you resell. You pay $4,200 more in interest over 6 months. Net difference, our loan costs you $4,200 more than the 8% lender and makes you $35,800 more. Now, let me give you a framework you can actually use on any deal. On a short-term loan, 6 to 12 months, a 2 to 3 point rate difference is somewhere between $3,000 to $8,000. That's real. I'm not dismissing it. But ask yourself this question before you sign with any lender. If this lender takes 3 times longer than promised, what does that cost me? Add up your carrying costs. Add up your earnest money at risk. Add up your appraisal fee. Add up the opportunity cost of 4 weeks. When you run that math, the rate difference usually, poof, disappears. And in a lot of cases like this one, you're not comparing $4,200 to $4,200. You're comparing $4,200 to $40,000. The rate was a rounding error. The execution failure was the whole deal. So how do you actually vet a lender before you commit? So this doesn't happen to you. I'm going to give you 5 specific questions. Use them every time. It doesn't matter if it's us or someone else. These are the questions that matter, that you need to ask your hard money lender before making a choice. Question 1, what's your average time to close? And then follow up. What was your fastest close in the last 90 days? If they hesitate, that tells you something. Question number 2, do you require an appraisal? This is a big one. If they require an appraisal, it's not going to be a fast close. Question 3, what are all of the requirements for funding? Is there a minimum credit score requirement? Do they require tax returns or a level of experience to get that specific interest rate you want? Question 4, who makes the funding decision, you or a loan committee? One decision maker is faster. A committee introduces variables you can't control. And then question 5, the one most people don't ask, what would be a reason that you would decline my loan? See what reasons they give. Ask about recent deals they've declined and why. Red flags in general, slow response times, appraisal requirement, specific experience or criteria or credit score to get the desired interest rate. Green flags, fast response times, no appraisal, one decision maker who picks up the phone. Rate is not dependent on experience or credit score. Vet your lender the same way you'd vet anyone in charge of your money. Now here's the part of the story that I actually love. This borrower, the same one who lost $40,000, came back to us 3 months later. Different deal, similar numbers. And this time, he didn't lead with the rate. He led with the question, how fast can you close? 6 business days later, he was funded and the deal was closed. It sold in 5 months. He walked away with a strong return and called me afterward to thank me. What changed wasn't the market, it wasn't the deal, it was one decision, who he chose as his lender. So before you sign with any lender on any deal, I want you to ask yourself, if this lender takes 3 times longer than promised, what does that cost me? Do the math, write it down, and then decide who you're signing with. Rate, it's just a starting point. Execution is the finish line. It's the whole deal. If you've got a deal and you need it to close fast, reach out. One call, one decision maker, no loan committee, no appraisals, no minimum credit score. And we funded over $550 million in loans. And we move fast because our capital and underwriting are in-house. That's not a pitch, it's how we are built. Link in the description, go to highwestlending.com, and before you sign with anyone, run your numbers on Deal Strike first. It's the deal analyzer we built specifically for real estate investor. Link is below. And if this video saved you from losing $40,000, subscribe, because this is what we talk about every week.